On today's show, 3 questions. Number 1, did the market just overreact? Number 2, what happens when boomers start retiring? And number 3, did Southwest just sell out? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
That's right, guys. Just 2 of us today. Rabih, you're back.
I'm back. I'm so excited to be back. How have you been?
I've been great. I've been missing you, and I was terrified for the last month the market was going to just completely crash. We were saying, as you heard, you said you listened to the show while you were out.
Yes.
We were a little worried. We were missing you, and then we were like, if there's any indication of a market correction, it's this. It's Rabih not being here for a month.
Dude, I have to be candid about it. I was laughing the whole time because I decided to go to Lebanon to see family members. And if you watch the news, it's all messed up over there. I land over there, there's nothing. We went and partied all the time, and suddenly the US politics just flipped the table on its head. And I'm like, I need to catch up with the US. What's happening in the US?
I was going to say, that is one thing that happened is you leave and things go wild in politics. The craziest 3 weeks we've had in a long time.
No, dude.
So yeah, it's funny that's the irony there. When you leave and all of a sudden you probably came back to be like, what is happening right now?
I left for 2 weeks.
I
can't leave you guys for 2 weeks.
Well, so since you were out for a couple weeks and missed a couple shows, we thought, you know what, let's just have more Rabih on this show. Let's make this just the Rabih show. And so we decided just to do you and me. Not really. We just couldn't get anyone else on the show today. Everyone's either traveling or busy with stuff. So, but let's jump in with the market update. So Rabih, the question is, did the market overreact? Tell us what you mean by that.
Yes. So on Wednesday, we even posted it on our social media. The stock market recorded its worst performing day for 2024 and since 2022. It was a very bad day for the market. The S&P 500 dropped around 2.3%. The NASDAQ dropped 3.6%, and the Dow 1.25%. So usually the market, you'd expect it to move a quarter percentage point, half a percentage point a day. When it's like the NASDAQ in a situation where it's moving 3.6% a day, that is an outlier. That is a left tail in the daily distribution. And we were at the office, and there were advisors here, and some clients called them. It's like, why is the drop so significant today? And I'm like, okay, we need to address it. If you've been investing in the stock market, you should be prepared for those. Those are a feature, not a bug, and they're going to be happening for multiple reasons. So we thought, let's navigate the noise about them, and let's look at what provoked them or what made them happen. I just wanted to mention, for the past week and a half, there hasn't been really economic news much. So most of the movements that's happening in the market is, 1, happening at lower volume. 2, is just happening due to traders, not fundamental information being incorporated into the prices.
So I was going to say this, Rabih. So how much of this is just people taking profits? Like people just
100%.
Yeah, it just happens sometimes where people are just taking chips off the table.
100%. So what triggered it was mainly earnings of tech companies. Tesla reported that
Tesla got crushed.
Tesla reported that they suffered a 7% year-over-year drop in their auto revenue, which made them drop 12.3% as a stock that day. But just to give you context, Tesla is only 1.3% of the S&P 500. So that is 1. 2, Google/Alphabet also reported earnings. They beat both on the top line, aka revenue, and the bottom line, aka earnings. However, their YouTube ad revenue wasn't up to the expectations, and as a result of that, Google dropped 5%. And for context, Google is only 4% of the S&P 500. So even if those two only on themselves dropped, it wouldn't have caused the S&P 500 to drop 2.3%.
Yeah,
there has been much more. And the most viable explanation could be is a rebalancing effect. So since the beginning of the year, tech has been doing really incredibly well. And if you are a sector rotation active manager, or just a manager that's trying to play value versus growth, etc., those plays, your portfolio as of before the sell-off has been concentrated in growth and tech, simply because those have appreciated vis-a-vis the other holdings, and you would want to rebalance your portfolio back to the risk allocation that you feel comfortable with. And just because the earnings season has just started and Facebook and Tesla were Google and Tesla were amongst the first ones to start reporting earnings, people just decided to be on the safe side and rebalance their portfolio ahead of the remaining amount of tech earnings that are going to be showing up, in case, just so they don't lose the gains that they've accumulated. So all in all, these together created this what we call rebalancing effect. It happens in currencies, it happens in fixed income, it even happens in stocks. And it was a one-day thing. It was a one-day thing, not only because there was a rebalancing effect. Earnings continued to happening. Just to give you some context, so far, out of the 500 companies in the S&P 500, 181 of them reported. So there are remaining 319 companies to report, more than half, and mainly bigger ones. We're talking NVIDIA, Apple, Microsoft, the ones that have been moving the market for the past year and a half. Only this year, 127 of them reported. So there has been this reporting, and since Wednesday, more companies have been reporting earnings, and it seems like the earnings season is still solid. Just those two big names did bad. So for Q2 2024 so far, earnings are expected to be 11.8%, which is high and similar to last quarter when we reported it. Out of those 181 companies that reported earnings, they are reporting earnings, 78.5% are reporting earnings above analyst expectations, and the long-term average is 66%.
I was gonna say, I think we've said it's 60-something%, right?
It's always been 66%. And if you've noticed, the last 4 or 5 quarters, they have been reporting in the 75 plus range above analyst estimates. So how good the earnings season has been so far with these 181 companies? As good as it's been in the last couple of quarters. So it is more of a very short-term adjustment behavior in the market, rather than an information that signals a change of trend, or information that people didn't have in mind. And with that, we look at the market, we'd be like, okay, so the market is an information crunching machine. There weren't information happening throughout the week. Tesla and Google decided to report earnings. People decided to rebalance as a result of that. That created a mini bleed for one day in the market. Earnings have been coming in mixed, but generally good. Why did the market recover after that? Like, we still haven't recovered completely. So if you actually look at the data since their all-time high for the S&P 500 and NASDAQ, and that's around July 16, 17, the S&P 500 has only dropped around 5%, and the NASDAQ has only dropped about 8%. So it's not even correction. You need a 10% drop for call it a correction. It's just a mini blip. And part of the reason is because we started receiving economic data. So there was the market-related data, the earning-related data, but then on Thursday and on Friday, this morning, economic data came in. And usually macro information trumps any micro information. No one will care whether Tesla is selling its EVs or not, if inflation is soaring or not. There's precedent for one over the other. And we received economic data. And dude, the economic data has been really good.
It just continues to be good.
It's been really good. So I was listening to that episode you did with Jake and Victoria while I was out. It's like at 3 a.m. in Lebanon. What do? I listen to the sense. Like,
and what happened, Rabih?
I fell asleep to your voice, guys.
We put you to sleep. Yeah,
it was so nice. You guys, I think, Matt, you were talking about the unemployment rate and how it hit 4.1%, right?
Yep.
So back last month in June, the Federal Reserve gave us the summary of economic projections, blah, 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 right? And what they said is that they want their target, or their expectations is that the GDP for 2024 is 2.1, unemployment is at 4, PCE inflation is at 2.6, and core PCE at 2.8, and interest rates would be at 5.1, indicating one rate cut. So we just received the remaining information. You said unemployment rate got to 4.1. It means if they tick 0.1% above their target, they want a 4, they're at 4.1. not a red flag, but they are there. Do not overpush it, right? We received GDP data for Q2 on Thursday, and that was very interesting information because they said they expect the GDP to grow 2.1% annualized. We got the Q1 data, and remember, they were bad. On an annualized term, they were 1.4%. And we kept talking and saying that if that 2.1 number of the Federal Reserve sticks, it means that Q2, Q3, and Q4 have to be way above the 2.1 level. So they average out to, the
2.1.
2.1. And interestingly enough, real economic growth for Q2 in its first publishing, because they edited it 3 times, is 2.8% annualized. You divide it by 4, but it's 2.8%, which means if you take the 1.4 and you add the 2.8 and you just take the average, you divide it by 2, this puts you back at 2.1, which is the Fed's target. So it didn't take them 2, 3, 4 quarters to adjust, and
one quarter we're there.
In 1 quarter, we're back on the average. So if you look at the expectations that the Federal Reserve submitted, they said they needed a GDP growth of 2.1. Halfway through the year, it is on target of 2.1. They said they want unemployment at 4%. Unemployment right now is 4.1.
Threading that needle, Rabih. We're threading the needle.
And then this morning, we got the core PCE and the PCE for inflation data. It's a great week. I got all the data I need. I feel so good.
You're so excited.
So their expectation for PCE inflation for the year is 2.6, and for the core PCE is 2.8. And it fell. Okay, hold on. I found it. So for the year, the core PCE is at 2.6 and PCE is at 2.6. So for the normal PCE, they're matching, but for the core, they still have 0.2% to go. So if you think about it, they are on target.
We're there.
And they communicated one rate cut simply because there's still a little bit like inflation. If it needs to remain 2.6 for the remaining of the year, it means it needs to stop dropping, because right now the core PCE is at 2.6, which means it's supposed to stay flat. The market does not think that it's going to stay flat. It's going to keep decreasing just like it's been. So maybe we end at 2.5 or 2.4. This means a weakening inflation, and the job market is at 4.1 versus 0.4, which is a softer economy than what the Fed communicated in June. They're going to update it in September. But this got me to a very interesting conclusion. The Fed has communicated one rate cut. However, the market is now pricing in 2 or 3 rate cuts, simply because...
By the end of the year, you're saying?
By the end of the year, simply because of this softening in the data. The data might come in and change it and bring us back to 1 rate cut, but the market is pricing in 2 to 3, simply because of a little bit higher unemployment and inflation that has already reached its target for the year, not the general overall target for the year, 6 months ahead. So this is where the data stays. And I know I spoke a lot, but I still have one point.
We're making up for lost time, Rabih.
We're making up for lost time. I still have the Fed meeting stuff, because next week the Federal Reserve is talking, and given that it's an election year, when they're going to cut.
Yeah, what's happening?
Given that it's an election year, and the Fed is, we're all speculating on when the Fed is going to cut rates. Is it going to be before or after the elections? Let's just look at what our options are. The Federal Reserve is going to only meet 4 more times for this year. They're going to meet July 30 and 31st, which is next week, and we're going to talk about what they hit. They're going to be meeting on September 17 and 18, pre-election. And then they're going to be meeting on November 6th and 7th. There's no October meeting. And after that, they're meeting on December. But the interesting part, the November meeting is November 6th and 7th. Election day is November 5th.
Ooh, okay.
All right. So if they decide, the expectations, the probability of them doing the first cut next week in July, according to the Fed Fund rate futures, is only 8% right now. The probability that they do the first cut in September, according to the futures, is only 12%. But the probability of them doing the cut in November, the first cut in November, is 60%. 2 days or a day after the election.
Yeah.
This is what the market thinks. This is what the market is pricing in. And if they think there are going to be 2 cuts, most probably the current path that the market is, betting on
November and December.
November and December.
Yeah.
But with that, it's so exciting. Next week, we're going to get the Federal Reserve. We're going to see what they say, what they communicate. And we've got, August and September to get new economic data to see whether what they publish in June is going to stick or not. And honestly, the market loves certainty. So the more we stick to expectations, the less surprises, the more we converge to long-term averages.
So, Rabih, first of all, that was amazing. I love that we have you back. We're back in the saddle with all these updates. But when I hear that the market is pricing in the Fed, like a higher likelihood that the Fed's going to make a move and actually cut rates after the election as opposed to before, maybe it's cynical, but I would say the market, what that tells me is the market believes the Fed is not as independent as we want to believe, or like as separate, like meaning it's hard for me to believe that's not like a politically driven move for the Fed to, and maybe as I say that, the argument against that is just to say the Fed just wants to stay out of all of it and they're just going to wait till things play out.
Yeah.
But I'd imagine that depending on how you look at this, that you could say this is politically motivated, or could you not? What are your thoughts on that?
It is definitely a valid point to consider, but also they are in a position, this is my opinion, not like...
Yeah, of course.
My opinion. I think they are in a position where they have the privilege to say we want nothing out of it. If unemployment rate is suddenly 4.3% and the stock market is slashing, 6% a day, like when it crashed in 2018 due to like Fed decisions, and they are being so late to react to economic data, they will not have that privilege and they'll have to act regardless. But honestly, yes, we know that the economy is softening just because they increased interest rates to 5.5%, right? But it's not a pressing issue. If they kick the can down the road for 2 months, we do not think it's going to completely harm the economy unless like something happens from now till then. But if stuff stay as is from now till 2 months ahead, the Fed is still going to be fine. Their economic plan is still going to pan out as they want to. And just because they're in this position of privilege to say, yeah, I cannot do anything for 2 months and will still be fine, is why people might consider that there will be political motives behind it. And honestly, they don't want to help any candidate. They're supposed to be independent. If it was a different situation, they would have to act and we would rule that scenario out completely.
Yeah. And I guess no matter how you look at it, either side, whether it's waiting, whether it's cutting before the election, like people are going to pull meaning or apply meaning to it either way from a political standpoint. So one side's going to say, oh, they're waiting to help this side, and the other side's going to say, it doesn't really matter. To your point, I tend to agree that they're remaining consistent with what they have been saying for so long, which is kind of like we're in wait and see mode.
Data dependent is the word
data dependent, and there's no right now, unless something critically changes and quickly changes over the next, knock on wood, but things have just kind of, yes, like you said, things are softening, but they're softening slowly.
Yes.
And we're still, all the economic data right now, as you said, is consistently been strong and looking like things are just kind of moving slowly. So there's no reason to act quickly when things are moving slowly.
Yeah. And the Fed, honestly, if they have a reputation, is acting too late. So
True.
We'll see how long it'll take them until they recognize the softening in the economy and then try to...
Well, that's what I was going to say is we said this, right? They got one of the biggest criticisms of the Fed was this whole idea of like, they held that line of inflation is transitory for so long until it was like, holy cow, it's not transitory. And then it was too late.
Yes.
So they've actually, to your point, been really criticized for that. So yeah, you'd think that even maybe have motivation to with that being said, maybe acting a little bit quicker than waiting too long. But
yeah,
again, they're going right along with what they've done. They're consistently kind of moving slow and not gonna push the gas pedal too quickly on this.
That's a good teaser for next week because
there you go. We're gonna tease it. Yeah,
we're gonna see what they're thinking of. Yeah.
Tease next week. I like it. Okay, perfect. So this goes into the next topic. which I think really plays into a lot of this kind of these macro trends, specifically around the job market. So the next question we wanted to hit is what happens when boomers start retiring? So I saw this article, and this is something that I think a lot of people are thinking about. This has kind of been in the backdrop of things, again, at the macro level of just the boomer generation is getting up there in age, and they are the biggest generation right now alive in America. And so they're far greater or far larger than, like, let's say the Gen Z generation who are entering the workforce. So some data points here that I found interesting and I think worth talking about, and again, how they relate to what we just hit and the impact of all these things. So a record 4.1 million Americans are set to turn 65 this year. And that's going to be the case until or through 2027. So 4.1 plus this year, 4.1 next year, and the year after. So 12 plus million people retiring in the next 3 years, which is kind of wild. And this is according to the Alliance for Lifetime Income Retirement Income Institute. That's a long name. Okay. So how does this impact the job market? There's a couple of factors here. So there are 8.1 million job vacancies in May, according to labor market figures. That's down from a record 12.2 million in March of last year, but still above pre-pandemic levels of 7 million. Rabih, you had data on this, how this relates to the unemployment.
So yes, those are the job openings in the economy, like how many jobs are available. If you want to see whether the labor market is in balance or not, in equilibrium, you compare it to how many people are unemployed, because the unemployed people should, if they match how many openings you have, your labor market is in balance. As of now, we only have 6.8 million people who are unemployed. Some of them will never go into the job market simply because of like other reasons, more structural reasons. Every country has a baseline of unemployment level that can get out of. But as you said, we have 8 million job openings and we've got 6.8 million people unemployed. This means there's more jobs than people unemployed, which still means the labor market is still not in balance, not in equilibrium.
Yeah. And keeping the job market, I guess, strong when it comes to, like, you'd think, right, that this would keep wages strong. It would kind of force wages to continue to increase, or to at least these companies have to remain competitive for a job market that is very kind of worker friendly, because there are more or less workers for these job openings. And this will continue to be the case, right? Because people continue to retire. And that's kind of what this article is saying. And this is why I'm saying it relates so much to what we're talking about at the macro level of what the Fed is deciding to do, the impact on the economy. So through the first 5 months of the year of 2024, that's how much data they have so far. There's been 900,000 people retired in the US, a pace that they're saying, if this continues, and they have no reason to believe it won't, they're giving a range of a record 1.7 to 2.1 million retirees.
So out of the 4 million people who are turning 65, 2 million are retiring, like around 50%.
Yeah. Wow. Yeah. So that's a great point. So they're saying record 4 million plus 12 million over the next 3 years are going to hit 65 or over the next 3 years in America. But that doesn't mean, to your point, that they're retiring.
Yeah.
Like they might continue to work continue to work or stay in the workforce. But yes, they're predicting that about half of those are going to retire this year.
That's a lot. I don't know. I think it's a lot.
It's a lot. I mean, it's a record. If they hit that, it'll be a record for 22, or a record we've ever seen. Here's the real, I don't know if you want to call this an issue or just an interesting point, and something that we need to be thinking about, again, how this impacts the job market and the economy. So the new entrants into the workforce, basically and this is mainly high school and college graduates entering the workforce, simply just isn't keeping pace. So they track this ratio. So there are this was as of May, there were 2.8 retirees for each entrant into the workforce. That's it's a record. They've never had that, and that ratio is continually increased. We used about 15 years ago, that was 1-to-1, and it slowly increased. So now we're almost 3-to-1 retirees to new worker.
So we're losing labor if we think about it.
Yeah, and we're losing labor. And a huge part of this, it's pretty straightforward. Again, the boomer generation is so large.
Mm-hmm.
We're having less children now in America, which is very common in a very developed nation. The more rich and developed a nation becomes, this precedent has been set for all of history. That the less you go from like an agricultural environment or economy into more industrial manufacturing, and you become wealthier as a nation, become more mature, birth rates go down. We're seeing this in Europe. We've seen this in all over the world, and so that's what's happening. The boomer generation is huge. They're also aging. They're retiring, and the new generation coming up that's entering the workforce just isn't as large. I think well, I'll leave it there, Rabih, and get your thoughts.
Lots of thoughts. A thing like this is generational. So when you're thinking of like its economic time horizon, we're talking decades, right? Like a whole generation is retiring. And when you start thinking of the economy in the long run, like there's a lot of like analysis, like in the short run, you look at interest rates and inflation, blah, blah, blah. But on the long run, honestly, the growth of your economy depends on two things only. And this is the neoclassical, theory of macroeconomics. It's supply of labor and productivity of that labor. And that's what's going to determine whether the economy grows or not. And if the supply has been dropping, as you have mentioned, we went from a ratio of 1 outflow into the labor market compared to 1 inflow. Now we're talking about 1 inflow compared to 2.8 outflow. You need to step up your labor productivity. And if you do not, this means higher wages for the inflow, but because higher wages for the inflow will trickle down and create higher prices everywhere, those boomers who retired will actually have to deal with inflation. We will not be living in a regime where inflation is 1.7% for 10 years like happened last 10 years. We're going to be living in a world where maybe inflation is 2.7 or 3%.
Yeah.
And for boomers who change their asset allocation because they decided to retire, that might be a hit for them. So our only hope is to increase productivity. And that productivity is going to come up. It's like how much output can this new entrant into the labor force produce? And it's going to depend on the technologies that we have. I think of my job like 15, 20 years ago, managing the amount of money we have, you need a team of 7 to 8 people, and now you can do it with just a handful simply because technology is there to aid you. So that's the hope for a sustainable growth path.
Yeah, I love that, Rabih. I love that we're taking this, like you said, more generational, more long term, because I think week to week we usually focus on what's happening, navigating the noise again in the short term, and what's happening with like the most recent economic data and things like that, and even focusing on like year to year. But to your point, this is more thinking big picture, like the impact over the next 10 plus years, 15, 20 years. Tell me if I'm wrong here, but as we go through this, I'm sitting here thinking there's really 3 ways to solve this. There's 3 focuses we have to have when it comes to this supply and demand, like you're saying, of labor and productivity. It's have more babies, right?
Yeah.
It's which I know you're not really for, and personally. So to have more babies, it's bring in more skilled labor via immigration policy, and then it's innovation and technology, right? Like those are the 3 areas that need to be focused on to solve, I guess, if you want. Like this is a problem. There's no way around it. Like this is a long-term issue that has to be addressed. To your point, this ratio is not necessarily, I don't know if you want to say sustainable. It just something's got to give. If you continue to have a 3-to-1 ratio of retirees to workers,
you're going to be running out of workers, and you can't tell those people work more. They've earned their retirement. Also, there's a really good part of the reason why you can't keep the labor force large by preventing people from retiring is because sometimes their skills are going to become obsolete.
Yeah. So true. Not to mention, I mean, this is a whole other discussion, later on, but like the stress this puts on, and this is why this is a huge topic right now, but the stress this puts on Social Security, Medicare, like a lot of these entitlement programs of the government, when these programs were rolled out at the time, the boomers were at the heart of their working age. Like the ratio was completely flipped. We had so many workers to retirees. It was like 16 to 1. And now it's completely flipped. So things have got to give there as well. We've got to be able to address the fact that the working population are the ones that pay into that program to support the current retirees. And when you have more retirees to workers paying into that program, that's a problem. Like we've
That
got
is
to
a
we've got
problem.
to figure that out.
Yeah.
So I am not.
Thankfully, Europe dealt with it before us. They just decided to increase the retirement age. Like you will
Yeah, which
not
is going
get.
to happen. It's got to have. It's going to have to happen. I mean, relatively simple solutions, not easy to implement. And I know there's going to be a lot of political back and forth on this, but yeah, there's things like, and they've already done this in the US, right? Pushing back the full retirement age. They'll continue to do that. They'll probably increase the age you can actually even claim Social Security. Right now it's 62. They'll probably increase that at some point.
Yeah.
They're going to
Which is
have
the
to.
lowest compared to other developed nations, by the way.
Exactly. Like
Yeah.
they're going to have to do that. They're going to possibly increase the actual FICA taxes that supply this. And I think another lever they have to pull on this would be increasing the limit, the income limit that they have right now, like the FICA limit of how much income's actually subject to tax.
Yeah.
So they're going to have to do something and pull on some of those levers to sustain this program, which I think they have to. It's like this is a political death nail if you say you're going to get rid of Social Security or not focus
Yeah.
on Social Security.
100%. So yeah, at this point, like thinking about it, it's a sunk cost. My generation and our generation is not going to be like our parents and grandparents. So what do we do about it? And I'll take your advice here, but the only thing I can think of, just know that you have to save more now, just to make sure you cover that gap in the years where those years were covered under your parents' lifestyle, but will not be covered on your lifestyle. And just make sure you're prepared for those, and just move on.
Yeah. Yeah, I mean, we get this question all the time: should I, should I be planning on Social Security? Is a question we get. The answer to that is I have no idea. I have a hard time believing they're not going to keep this program going, and they're not going to find a way to keep it going. But I really don't know. My take on this, and purely opinion, to your point earlier, is if you're over the age of 50, there is no risk. Social Security is going to be there for you if you're over the age of 50. If you're under the age of 50, it's much more up in the air. But again, I think it's going to be really difficult to get rid of from a political standpoint. So they're going to find a way to keep it going. It's still, I think, one of the most, if not the most popular program ever created by the government. So I have a hard time believing they're ever going to get rid of it. So, but things have got to change, no question. So I wanted to hit this really quick. I just think it's interesting, again, as we talk about the economy and how much this demographic shift is impacting like specific industries. So they break down in this article percentage of different areas of the economy. So, for example, like wholesale trade. So this consists of, it says middlemen and distributors selling goods and wholesalers to retailers. Over 27% of this group of workers are 55 and older. Financial services, shocker, even though we are on the younger side, 26% of financial services. This is like investment banks, insurance companies, real estate firms. In this sector, 26% 55 and older.
Wow.
Public administration, 25% plus are 55 and older. Manufacturing, huge part of the economy, although we're shifting a little bit away from that now. It's more services based, but over 25% 55 and older. Transportation and warehousing, about 24% 55 and older. So educational services, 23%. Healthcare services, over 23% 55 and older. Again, I just think it's interesting, these different areas of the economy that we're going to have to focus on. And maybe that's like some, obviously we speak mainly to dentists, but this is more general, where younger people can maybe start putting their focus, if right, taking this and be like, where should I be putting my focus and my skills to try to get into these industries that are going to have a huge gap here over the next 10, 15 years of workers leaving, leaving these areas.
A counter argument would be those industries themselves might be becoming more and more obsolete. Like I can't imagine myself, telling an 18-year-old, hey, go into manufacturing, just learn how to get an assembly line. It's
for sure.
And if we get data about industries where they have, I don't know, AI research or social media marketing related stuff, what's the percentage of 55-year-olds and over in those industries? It's going to be much lower. So
Totally. Well, here you go. Information. So technology jobs, only 20%, it
20.
says,
Okay.
55 and older. So to that point, you're totally right. It's, you could look at it and say, oh, these are the industries you want to go into. Like, for example, healthcare, dentistry, whatever it is, might be something you want to look into. But then you look at something like, to your point, manufacturing, or let's say like transportation and warehousing, whatever, that those workers might be like in those sectors, it might be more where innovative technology is going to replace those workers
Yes.
and that productivity in certain sectors, depending on what it is.
Yeah, they're like the last generation in that industry.
Exactly.
Yeah.
Yep. That's a great point. Anyway, anything else? I thought this was super interesting. I think it's a really change of pace of thinking, kind of bigger picture. I thought it was very much worth talking about. Just to kind of like, again, even just talk about the trends that we're seeing and the data that's out there, to your point of generationally what we're facing right now. Any other thoughts on this?
No, it's good, and all of these are really objective data. Like we do not look at, oh, the boomers are much more than the millennials and 2.8 versus 1, and we're sad or happy about it. It's just like, this is the reality, and how are we going to plan around it? Like, this is it.
Yeah, exactly. It's totally true. Yeah, there's there's just the numbers are the numbers. Like,
Yeah.
you have a large population in the U.S. The biggest generation currently alive they're all retiring over the next 5-10 years, and the younger generation is not big enough to support, as from a body count perspective, and so that the data is the data. And
Yeah,
we're
100%.
just
Because you can make arguments for both sides. This might be so bad, and we will not have enough people, and we can't pay for social security
or it's
and political
great.
turmoil. Or it's great because you have less labor, and everyone's going to be making much more and living a better quality of life, spending more, making everyone's life better. You
Yep.
can make arguments on both sides, so you just look at it and plan around it.
Yeah, totally right. Okay, love that. Last topic. This will be quick, but we thought we'd hit this. Maybe we'll tease this and we'll bring it up again when we've got some other advisors on, because some of our advisors have some hot takes on this. Taylor, shout out, we love you. But we swapped this article back and forth on our Slack channel with the advisors. It's actually Ryan who posted this. He couldn't be here today to talk about it, but here's the article from CNBC. Southwest to get rid of open seating, offer extra legroom in its biggest shift in its history. So for those of you that don't, I mean, I think everyone's kind of familiar with Southwest and how they're different, but very, very different. Over 50 years ago, they made this shift. They zigged when airlines were zagging, and it really led to them gathering tons of market share and being very, very popular. In the airline industry, they offered lower prices. Again, I think most people out there probably understand the difference between Southwest and other airlines. I, for one, hate Southwest. Not as a company.
Never been on a Southwest
Okay,
flight.
I'm weird, but I don't like flying Southwest. I don't. Again, I'm not saying I hate Southwest as a company. I think they're super innovative and they've obviously done an incredible job. But I don't like flying Southwest. I hate the first come first serve. Like, I just like buying my ticket. So that's what Southwest has done for years.
Okay.
Is they do this what they call open seating, and so you book a flight, you don't have a seat yet, and then you have to. There's like a time, like that you can go and basically it's like literally like clicking as fast as you possibly can to get.
Oh, it's not running into the airplane, because I'm getting
No,
like
no, no,
Black Friday imagery in my mind. People
no.
rushing into the airplane trying to secure a seat.
I haven't flown Southwest for a while, but if I remember, so you get your ticket, and then like a certain amount of time before your flight, you get on, and you have to like, it's like kind of pre-sale for concert tickets. It's like you got to
Oh,
like get on and click, and the faster you check in for the flight, you're grouped in either A, B, C, or D, or whatever.
wow.
And then as you get there, there's lines. It'll be like group A 1 through 30, group B 1 through 30, and then your ticket will tell you where you are, and you literally line up where you are.
Okay.
I just don't love it. For me personally, I'm weird. Maybe I'm not weird. I don't know. Clearly, I'm not weird, because Southwest is now changing it, because they have been getting kind of crushed when it comes to their earnings. So Oh, I'm not weird. I'm actually reading this article right now. It says 80%,
Matt, you
80%.
are not weird.
I'm not weird. I mean, I am weird, but not for this. 80% of its own customers prefer an assigned seat. Thank you.
Okay.
Who doesn't want an assigned seat? Let us know. If you're out there, I know
There's
Taylor loves
nothing worse than
Southwest.
being stuck in a middle seat, especially on a long flight. I can't stomach it.
Yeah, no, I just want, when I buy my ticket, I want to be able to have the ability to be like I fly Delta on most of the time, and I can go on there, get the seat map, pick where I want to go. You know, if I want to save some money, I'll go in the back. If I'm okay spending the money, I'll go in a comfort or whatever. But I'm usually wanting to be in the aisle and not, like you said, not be stuck in the middle. Like I don't love and apparently again, 80% of its own customers want the assigned seat. So they're basically going the way, and this is why Taylor's so annoyed. Shout out Taylor. He's very much a Southwest guy. They are going the way of basically Delta, America, American, all these other airlines. This really, here's what I think is interesting. This shifted, and I'd love to get your thoughts on this, Rabih. So basically, there was a massive investment by Elliott Investment Management, an activist investor. They came in, took a $2 billion stake, and basically came in and said, we need new leadership and we need to make some changes. This is after Southwest reported, or kind of coincided with the fact that Southwest reported a 46% drop in quarterly profit.
Whoa.
They just reported this on Thursday, 46% drop. So this again comes at basically this Elliott Investment Management Group came in, took a huge stake, and said, we're changing your whole business plan.
Yeah, I'm trying to put my brain in their position and what they're thinking of, and I think the big question is there: how does Southwest compete compared to other companies? Does it compete based on its customer experience, where you have to race for your seat, and or does it compete on because I know Taylor has a connection with his credit cards because he's a credit card master. Like, do they compete on access to customers and how they do it, or do they compete on their routes and which airport hubs do they connect to? So it's more of let's decide on how Southwest competes to other airlines and just double down on that. And it might be that their customer experience is not how they compete, so they just decided to go with the traditional way.
Yeah, it's interesting because I think 50 years ago and over the last several decades, like they have competed on having just better customer service than a lot of these airlines. They really, I think, prided themselves on just being different, being more approachable, being more fun. Okay. There's like videos that came out a long time ago around like how their flight attendants like interact with people, and when they make announcements or like being funny, and they're just much more of approachable, fun airline. I also think their routes, to your point, I also think they pioneered a lot of these, like, we all know airlines suck when it comes to how they segment their, and it's only gotten worse, like how they segment their seating, how they're like, oh, you want to like have like you bought your ticket, but now you want to have like, oh, you want to have a seatbelt? Like you got to pay extra for, oh, you want to like sit in an actual seat? Oh, you want water? Like, I understand how annoying that can be. And Southwest, I think, for a long time prided itself, and I think grew on the fact that it was pioneered on like no change fees and no baggage fees and things like that. But clearly something has shifted, and I think this is probably more of a story of like, while not as egregious as, let's say, like a Blockbuster or a Kodak, not as egregious as that, because those companies went bankrupt because they wouldn't pivot. But I do think this is maybe a story around Southwest. The game plan they started and implemented worked for a while until it didn't. And I think maybe they're learning the lesson of like they didn't adapt with the changing economy.
Or because they're competing on their brand image and how customers view them. Wasn't it last Christmas or the Christmas before where like all Southwest flights were halted and suitcases were in airports? So when you lose your reputation, it's very hard to make it back, and this will impact your balance sheet and income statement. So hopefully they get a way out of it with the new adjustments. Honestly, I can speak for both of us. For people who are over 6 feet, I'm all for extra legroom.
Oh, for sure.
Let's
Totally.
see
Yeah,
where they end up.
it depends on where I'm flying, right? If I'm doing a quick little trip to California or something, I don't really care as much. But if I'm doing a flight that's over 2 hours or more, over 2 hours, like, yeah, I want extra legroom. I want the option to do like a comfort option, right? Where I could, like you said, over 6 feet tall, I'm a larger person. I would like to have some extra space. So yeah, we'll see what happens. But I thought it was interesting. I know Southwest, again, as we've seen just internally with our own team, has you know, kind of those extra, there are those fans, right? Like Taylor is a huge Southwest fan. I
We'll
don't
have him next
really
week. To
care.
make his
Yeah, we'll get Taylor on here and we'll talk more about Southwest. So, all right, Rabih, anything else you want to add? Any other final words of wisdom for the good people? Any other team? Oh, we're going to end with this. Happy Olympic Day.
Oh yeah,
It's the start of the Olympics. Are you a big Olympic fan?
Yes, I'm all for Team USA in the basketball. We need to bring in the gold just because in the last World Cup we lost to Germany, and that is not cool.
So far, looking super competitive. I saw a thing that said in the 2020, is it, or 2022? I can't remember. Whatever. The last Olympics, I know, got kind of thrown off with COVID. But the last Summer Olympics, the average margin of victory for the U.S. was 20 points a game. In that preliminary tournament they just did, like the exhibition tournament they just did, the average win for the U.S. was 10 points a game. So it's been cut in half. Far more competitive right now. And this is just showing like how much basketball has become like a worldwide sport.
Yes.
You've got so many incredible players outside the U.S., but I also have a hard time believing the squad they're bringing out this year is not going to win. Like,
they have to.
It'd be pretty bad.
They have no other
if you don't win this with this team that you have. So it'll be interesting. I love the Olympics, and this is kind of personal to us because they just announced. I don't know if you saw this, Rabih.
Yes, I'm so excited. Now I'm looking for a house.
Yeah, they finalized and made it official that Salt Lake City is getting the 2034 Winter Olympics again. I remember I was a sophomore in high school when the Olympics were here in 2002. It was so much fun. So I'm really excited for that. It means a lot to get that. I might not be here, meaning I might just like Airbnb my house and take off to Hawaii or something. But it's fun. It's a really cool thing to have the Olympics here again. So, all right, Rabih, so good to have you back as always.
So happy to be back.
Yeah, we're happy to have you. You can't go anywhere again for a while. We need you on this show. So, as always, thank you everyone for listening. That was our 2 cents. Till next time, have a great weekend. Bye-bye.